In the late 1990s, the internet was about to change everything.
Tonight, the information superhighway and one of its main thoroughfares, an online network called Internet.
Investors were pouring billions into tech startups with little more than a .com in their name. The Nasdaq soared, and everyone wanted a piece of the action. But what goes up must come down. This is the story of the .com bubble.
Now that I've gotten on the internet, I'd rather be on my computer than doing just about anything.
It's really cool.
The internet gave us a whole world of exciting new possibilities.
It all started with a revolutionary technology, the World Wide Web. Suddenly, anyone with a computer and a phone line could access a vast network of information. Entrepreneurs saw limitless potential, and investors were eager to fund the next big thing. Companies like Amazon, eBay, and Yahoo were born, promising to reshape entire industries. As the 1990s progressed, venture capital flowed freely into Silicon Valley. Startups with catchy names and ambitious plans sprouted like weeds. The IPO market exploded, with companies going public at astronomical valuations despite having no profits. The media fueled the frenzy, touting the new economy where traditional metrics no longer mattered.
Another internet IPO. Ask Jeeves, just ask him. He went public today and opened up 400%.
By 1999, the bubble was in full swing. The Nasdaq Composite Index more than doubled in a single year. Day trading became a national obsession, with regular people quitting their jobs to play the market. Companies like Pets.com and Webvan raised hundreds of millions despite flawed business models. But not everyone was caught up in the euphoria. Some analysts warned of a bubble, pointing out sky-high valuations and the lack of fundamentals. But their voices were drowned out by the chorus of bulls proclaiming a new paradigm. In March 2000, reality finally caught up with the hype. The Nasdaq peaked at $5,048.62 before beginning a brutal descent. As investors sobered up, they realized many .coms had no path to profitability. The selling snowballed, wiping out trillions in market value. By October 2002, the Nasdaq had fallen nearly 80% from its peak. Countless startups went bankrupt, and even the survivors saw their valuations slashed. The era of easy money was over. Fast forward to today, and we're seeing eerily similar patterns with artificial intelligence. Tech giants and startups alike are racing to integrate AI, with investors once again throwing caution to the wind. Companies like Nvidia have seen their stock prices skyrocket, reminiscent of other companies' rises in the late 90s. Now here's the question, will history repeat itself? There is a lot of hype behind artificial intelligence, and every tech company seems to be throwing huge sums of money at various ideas. Will this AI bubble eventually burst just like the .com bubble, or will investments in AI truly pay off? It is important to remember that stable businesses matter more than hype and buzzwords, and what goes up doesn't always stay up. With all these developments in AI, it's essential to stay informed about the current financial landscape. If you're interested in understanding how major players like JP Morgan saved America's economy, check out my video on the JP Morgan bailout.